Good afternoon, ladies and gentlemen. Of course, I say good afternoon to those of you joining me here on the East Coast. We are just after 12 noon Eastern Time. It's great to see you all here. Of course, I'll say good morning to those of you joining us in the Central Time Zones, the Mountain Time Zones, and the Pacific Time Zones as well. And of course, good evening for any of you joining us from across the pond in parts of UK or parts of Europe, and good early morning to those of you who might be joining us from Asia or Australia. Welcome to the presentation. Today we're going to discuss what is possible with the radioactive trading techniques we discussed the other day in our presentation on how to fight the fear and embrace your greed for 2018. For those of you who don't know me, of course, my name is Mike Chupka. I'm the Director of Education here at Power Options and at RadioActive Trading as well. Now, as I mentioned, of course, what we're going to talk about today is the benefits. What is possible with one simple tweak to your trading strategy and your trading approach that can put you in control of your losses and greatly benefit your portfolio. In a general rule, what is possible? Every position that we start off with in the radioactive trading techniques starts with a combination of a stock and put. A married put position, which is essentially nothing new. You've read about it, you've heard about it, you've seen it on probably your brokerage account, other educational sites, even Investopedia. But the structure to properly set up a married put, to put the risk factor into single digits, to put time on your side to get the maximum performance out of the structure is what we teach at radioactive trading. Now, we don't just put on a position and then say, hey, going forward, I think the stock's going to go up and I'm going to have huge profits. There are different income methods, adjustments that we teach that can be used to take that initial single-digit risk, lower it by applying the adjustments, and potentially even cancel all of the risk to where we have what's called a bulletproof position. Is there such a thing as a no-risk trade? Absolutely. And we can do that all the time, and we see that often in our personal trades that we post for our Fusion subscribers at Radioactive Trading. All right, a quick story. I personally began trading options and working with Ernie Zarena and the Power Options staff back in 2001. Ernie Zarena created the tools back in 1997. Now at that time, there were two separate services out of Texas that were teaching covered calls. Not spread positions, not anything else, just teaching a covered call technique. Their students would use our patented covered call screen to identify the positions that those instructors taught them to look for based on the stock technicals, fundamentals, premium that they wanted, time frame, and more. Now, these two different services were actually two different approaches. One group taught structure and focused on allocation of your account into one position. And they'd actually start off with a covered combination position, meaning they'd buy stock, they'd sell an at or out of the money call for a covered call, but then they'd sell an out of the money put, which they'd have to put up the cash to cover that because the obligation of the naked put is not covered by the stock or the short call. So they almost have twice the amount of capital allocated into the covered call to cover this naked put play. Now, if the stock fell, you bought more shares, and if it continued to fall, you ended up being called in winter. Meaning if I got a stock at 50 and I sold the 50 call and sold a 47.5 put and the stock fell to 46, I'd buy another 100 shares at 47.5 for the put obligation. But if the stock continued to fall to 42, 41, or $40, I can't sell a $40 call because I'd get assigned at a loss. So they would say, wait, don't do anything. Don't sell more premium. And if the stock keeps falling, well, you're in winter. Eventually, it'll come back. The other service promised 3 to 6% monthly returns using covered call strategies. And when they were asked what to do if the stock fell, I buy a stock at 50, I sell that 50 call for $2, I maybe have a 3%, 4% downside protection, the instructors kind of snapped and said, you don't care if the stock falls. Keep selling premium. If it falls to 45, if it falls to 42, if it falls to 40, just keep selling calls. You'll be fine. Don't ask me about the stock falling. Don't even bother with that. You don't care about that. Just keep selling premium. Well, personally, if I'm in a portfolio and I open shares of stock at 50 and I watch that stock over 3 months drop to 30, where I'm down 20 points, I do care. Even if I'm generating 80 cents or 90 cents with the at-the-money call, I absolutely care that my stock is down $20. Now, during this time, Ernie and I would get calls from these students. And they'd say, I had a couple positions that fell. One broke through my stop order and I have a 16 to 17% loss, maybe even a 20% loss. Or I'm in winter and I don't know what to do. How can I better protect from these declines? See, the losses pile up more quickly in that type of structure. Even if you're right 60 to 70% of the time, if 30% of your losses are 10 to 15%, you're only generating 2 or 3% on your winners. You're wiping out 10 to 12 previous trades. Okay? The gains are capped and the losses are piled up. Well, my answer, since I had personally moved from covered calls to this strategy, was to buy a put. Create a collar position. Because I had a similar approach in my first 8 months, noticing in my portfolio that the losses, even with stops included on the covered call positions, were starting to outpace the gains. I was still right 60% of the time, 65% of the time. But a loss of 10 or 12% is taking out 6 to 7 previous trades. So I had moved into what we call standard collars after my first 8 months or so of trading covered calls. A standard collar is a simple trade. You buy stock, you sell a call against it, just as you would with a covered call, and then you buy a lower strike put with the same expiration as the call you're selling. Now, the put is a lower cost because it's further out of the money, typically. It does give you a controlled risk. Profit and loss chart we're seeing here is similar to what you'd see on a bull call debit spread or a bull put credit spread, but it's not a leveraged trade. In this example here, current example from this morning on applied materials, if I bought the stock at 52, we could sell a 53 call and buy a 50 strike put. If I'm right and the stock moves up, we get assigned. I still make about 2.6%, close to $100 on this position. And if the worst case scenario happens, the stock falls 17, 18% in the next 5 days or so for an unknown event, my risk is controlled to only 3.3%. But it still has a capped upside. Think about those numbers for a moment. If I open 10 positions, 10 collars with a similar structure, where I'm looking to make 2.5% return on those that I win and get assigned, and the most I can lose is, let's say, 3.5% if the stock falls more than 2 or 3 points in the time frame I'm in the position, I still need to be right close to 68% of the time in order to profit long term. You're not always going to see the full loss. You're not always going to see the full gain. But as a trading record, you need to be right 65, 67, 68% of the time with this structure to profit long term. But it stops the pain from covered calls if the stock fell 17% in the first 5 days of the trade, and I'm forced to roll down the call to protect it, but I'm only generating 2 or 3% of the time. Now we're talking 5 to 6 months of management on the hope to get back to break even. But see, they didn't want to hear that. They didn't want to hear about putting more money into the position. And when you buy a house or you buy a car, you have insurance on that. You don't want to lose that investment. But when we talk about investing, we talk about the benefits of options, selling premium to see income coming in, lowering our cost basis. That sounds fantastic. But when you incorporate the downside risk to the position, you don't want to hear that you have to pay money for insurance. What they wanted to hear from myself and from Ernie, from an outside expert, beyond the $3,000, $4,000 they paid for a 3-day seminar to learn covered calls, was, what magic option strategy do you have in your pocket that I can do with options to sell more premium and get more premium to lower my cost basis and protect my positions if they fall. Can I sell more puts? Can I sell more calls? Well, now you're in a ratio play which takes infinite risk to the direction you originally thought the stock was going to go. Or you're taking the risk of selling more puts to generate more premium to potentially have to buy more shares of stock trying to average down, but now more of your portfolio is being put into a losing position. The stop orders weren't working. They don't want to hear about putting more money into the position. So is there a magic way to generate income and stop the losses? Well, there wasn't. Even with all the things we see today of broken wing butterflies, ratio back call spreads, ratio put spreads, with that type of structure, the only way to protect the downside to guarantee it would be to buy a put. And that's what we look at. Every position we open at RadioActive Trading focuses on limiting the risk first. Rather than looking at the income, we want to let that come later and at a better time. But why limit risk? Well, of course, the obvious is to avoid the unexpected and to ensure our positions. In any trading strategy, whether you're doing spreads, whether you're just buying calls or buying puts speculating in a market movement, you're going to have strings of winners and losers. I can show you a set of criteria on power options for bull put credit spreads that would have taken in 4 times the amount of money you invested into it over the last 12 months. But at one time, even with the market the way it was, that portfolio was down about 28% of where you started because of the lie of leverage. Controlling the risk is the only thing we can control in the market. Now think about the structure we just showed on the collar. Now I can enter positions that have the potential to make 2.5% to the upside. I could use an at-the-money call to get a better probability, maybe even slightly in the money. But I can't control if the stock's going to stay above that price and I'm going to make the maximum return. You can't control that in a covered call either. All you can control is what premium you receive based on which strike you choose. You can't control what the stock does next. In the collar structure, I can control my risk. But if I pick the right stock that moves up 15% in the first 20 days I'm in the trade, or 25% without adding more money in the position to rolling the call, I don't get further upside. I can't control that higher delta gain because the structure of the covered call or the collar. But at least in the collar, I can control the risk factor. So the only thing we can control in the market is how much we're willing to risk on each position. We prefer to do it by proper structure. Also should be done about allocation in your position. I'll talk about that more in a moment. Now, what's so special about limiting risk? Look what happened in NASDAQ earlier this month. From about November 29th to December 5th, out of nowhere, everything was looking good across the market. The NASDAQ pulled back close to 200 points, dropped from about 6,400 down to about 6,200. Sure, that's only 3%, but we saw other 7%, 8% losses in other positions. I was in a NASDAQ stock, Applied Materials AMAT, during that time, and that stock dropped from $59 to $48.50 during that 5-day time frame. All right, and here's what we see. NASDAQ here is on our little black marks here, or little tick marks here. This was a this is just a 1-month chart, okay? And right here we're looking at about November 29th. And starting on sort of December 1st, we see a decline here of that minus 3%, close to that minus 3% in the NASDAQ. Well, at the same time, you can see here that Dow Jones, I've got it up here as a file, but Dow Jones in a comparison actually moved up about 3 or 4%. And SPX was up as well. Little sympathy here on this decline, but you can see the two performances. If you had bought calls on NASDAQ right around November 28th here, as the stock was, or the security, the index was moving up in price, you'd be at a loss at the end. These other two, you'd have a reasonable gain. That's only 3 or 4%, 5%, I'm sorry, for DJX, about 3.5% for SPX, but on a leveraged call, that could have been extraordinarily profitable. What about other structures? And we talked a little bit about the covered call, but what about these bull put, these bear call spreads? I had a customer ask me yesterday about spreads on indexes. What is the risk of trading bull put, bear calls, iron condors on broad-based indexes such as SPX, NDX, DJX, Russell 2000? Well, use this as a base point. Here's a position we could have opened on NDX for November 28th. It would be a bull put spread. Remember, NDX was trading about 64.22. I could have sold to open a 15 December, about 18 days out, 6,200 put at 10.10. At the same time, we would have bought a 61.75 put for 8.95. It's a leveraged trade, a 25-point spread. We get a net credit up front of $1.15, and the return would have been 4.8% against the 23.85 monetary risk for the spread. At the time, because of the movement of NDX, because of the volatility, this had a 91.3% theoretical probability that the stock would be above 6,200 in the next 18 days. Common of what an investor would look for with a leveraged spread trade. Want a good probability of 80, 85, or 90%. You might look for a higher return around 10 or 11%. Of course, you'd have to have a lower probability. You'd be in about 75 or 80% range at that point. He wanted a 90% probability with at least $1 net credit. So here's the position that was found. 6 days later, on December 4th, that's when the NASDAQ was at its low point. It was within 1% of the short put strike price. It's a common trigger point for investors to look to manage that bull put or close it. But on December 4th, that 6,200 put was priced at 48.65, meaning to adjust, close, or liquidate the position, I'd have to buy to close the 6,200 put for 48.65. We took in 10.10. Okay, so this is a pretty expensive buyback. Now, of course, we could have sold that 61.75 for 42.15. Right, do the opposite transaction. We liquidate the spread for a liquidation value of about 650, 655. We took in $1.15. My loss on this spread is 540. Now think about if I'd opened 5 positions with similar risk-reward structure, $1.15 net credit, 91.3% probability. This one hit the trigger point where it had to be exited or adjusted, and we take a 540 loss. Well, that would have wiped out the gains, the net credit essentially, on almost all 5 of the other positions. I would have taken in 575 total net credit. Now I have to close it for 540. 1 out of 5 trades, 80% probability, and I'm making a very minimal profit of perhaps only 30 cents or 35 cents. That's the lie of leverage in action. And for your spread traders and for covered call traders, we can illustrate this with the Trade Simulator tool. Now you can see this yourself later on after the webinar. You can go to radioactivetrading.com and click on the Resources tab and put in your numbers. But let's take a look at a common spread structure. I want to do a bull put or a bear call even, 20 to 30 days out in time. Now let's say that I want to look at 5-point spreads. I want a good probability of 80 or 85%, and I'm expecting to get a 50-cent net credit. Okay? Well, that means that I'd take in 50 cents credit on a 5-point spread, so my true risk would be 450, or the margin requirement the broker would charge me. This would equal an 11.1% return. We're talking about a 2-point spread, you're looking at 20 cents and so forth. But that's looking for with an 80% probability, an 11.1% return. So in the Trade Simulator tool, there's 5 different things that we can enter. I'm going to enter in a target return of 11.1%. Now I'm going to set the loss limit, my stop, at 50%. meaning that if the stock falls and it costs me $2.25 to liquidate the position because it's going the wrong direction in a bull put spread, I'm going to close it for half the loss. And I'm expecting to be right 80% of the time. So we're only going to be wrong 20% of the time. And for proper allocation, I don't want to put everything into one basket. We're going to take an account with $10,000, but I'm only going to invest $2,500 into each spread, 25%, so I'd open 4 trades on $10,000. Now, what the trade simulator tool does, it takes my inputs. It flips a coin 100 times. Heads, we win 11.1%. Tails, we lose 50%. And we're going to look to be right about 80% of the time in our coin flips. Here we see a fantastic trading record, where if you were right 88% of the time with this type of structure in a spread portfolio, at one point you would have more than doubled your money, and you could have an ending amount that's more than double the money, 100% gain. And at one point, okay, we had a drawdown, there we see it again, of about 27%. Because strings of winners and losers with leveraged spread trades, you're going to see fluctuations. Okay? But we opened the portfolio with an 80% probability. We were looking for spreads with an 80% probability. And here we were right 88% of the time. What happens if that changes only slightly? Here's the same settings. An 11.1% target return. Control the loss to only 50% of what we invested into each spread. Probability of loss only 20%. We're looking for 80% probability of success and 82% winners. So we're right more than 80% of the time. And at one point, we're down about 40%. And we end up with a loss of 15% on the portfolio long term, even being right 82% of the time. We're looking for 80% probability trades. And it goes down quickly. If I ran this and we had a 74 or 75% winners, the portfolio is actually down to about $2,800, $3,200 at different intervals based on the frequency and order of wins or losses, the strings of winners and losers. This is the lie of leverage in action. If you look for spread positions that have an 80% probability, you actually need to be right 84 or 85% of the time to profit long term. I think many of you might have seen that in your personal portfolios over the years and even over the last year. I just want to check real quick. While we're looking at this and seeing how this could perform out, even if we're right 80% of the time or more, we can still have a losing record. But I just want to know real quick. I've covered some of the ideas of covered calls, the risk here of leverage trades, of credit spreads. By the way, this also includes call buying. You know, if you're buying calls or buying puts, speculating on a market movement in one direction or the other, and you're right only 60% of the time, probably on most of those calls or puts you bought, something happened where you suddenly realized 100% loss or 90% loss in the position. Even being right 65 to 70% of the time, maybe even seeing a couple positions that made 200 and 300%, you're still probably at a small loss in your portfolio. That's the lie of leverage in action. All right, so I've had the poll open for about 35 seconds, 40 seconds or so. I'm going to leave it open for a minute. I encourage you to vote, and of course you can always send in a comment at any time using the question pod if there's a strategy you didn't see here in the list, or there's something else you're trading as well. Okay, so let's go ahead and, oh, we have an even split now, so I'm going to leave it open a little bit longer. There we go. All right, so let's go ahead and close the polls. And I'll share the results with everyone. So 43% of those of you in the audience today are doing covered calls and cash secured naked puts. 29% are doing call and put buying calls and puts, maybe legging in and out of straddles and strangles. 29% of you are doing the leverage spreads, the bear call spreads, and so forth. No one's really doing the broken wing butterflies or ratio spreads, and no one's doing stock only. All right, so let me take another look here. Let me just ask this question. And it's not about percentage. I can review that with you in a moment. We did that yesterday, and I'll review those numbers too. But think about your trading over the last, let's say 12 months with the strategies you're using. What best describes your experience, your portfolio over the last 12 months? Did you have more winners than losers and made money last year? Did you have more losers than winners and lost money? Do you potentially have more winners? Maybe you're right 55% of the time or 60% of the time or more, and you still lost money. Are you about 50-50, just treading water and not seeing the responses that you want, not seeing the goals gain that you want? Maybe you just had a bad year. You're looking for a market correction. You kept trading bearish positions, thinking the market was going to correct, and you just kept getting cleaned out, and you're thinking about quitting just to stop the losses on the position. And by the way, this is completely anonymous. No one's going to see what you answer here. I just want it to be a gauge for the audience to see how everyone else is doing. I'm not going to call anyone out by name or anything like that. I wouldn't do that to you. Okay, so we almost had the poll open here for about a full minute. We'll close it in just a second. All right, let's go ahead and close that poll. Good majority of you have voted. Let me share the results. 38% of you had more winners than losers last year, and you made money. Well, fantastic. Congratulations. We're still going to try to see if we can help you do better going into 2018. 25% of you had more losers and lost. Now, 13% of you had more winners. You picked a good trading, you had a good trading record percentage-wise for winners to losers, but you lost money. And 25% of you are about 50-50, you're treading water. Okay, you want to see maybe a better way to control that and a better way to get ahead. All right, let me just go ahead and hide that, and I'm just going to blurt out some numbers for you from yesterday. Yesterday I ran a poll in our, or 2 days ago, I'm sorry, in the Fight the Fear, Embrace the Greed presentation. And of the attendees that answered the poll, we asked a poll of percentage-wise, how much money did you make? With the SPX and the broad index is up about 20% or so over the last year. 17% of the audience said they made 30% or more on their portfolio. And 33 were between 20 and 30. 17% of the audience was between 10 and 20. And 17% of the audience was about break even, and another 17% lost money. Okay? One of the reasons those of you who had more winners than losers and still lost money might be due to the lie of leverage. The lie of leverage is a really simple thing, but a lot of the option strategies we like to trade fall into this trap, especially if you're not using proper allocation into a portfolio. If you're in an investment and you realize a 10% loss, you don't need a 10% gain to get back to break even. You need an 11.1% gain on what's left. So if I took $1,000 and bought calls on a stock and it hit a 10% trigger and I closed it for a 10% loss, well, I've got $900 left in my portfolio. If I make a 10% gain, I'm just back to $990. I need 11.1% gain to get back to break even. And this goes fast. At a 25% loss on a position, you need a 33% gain of what's left to get back to break even. And at a 33% loss, you need 50% of what you have left to get back to break even. And of course, we all know if you take a 50% loss, we need 100. But in a controlled structure and with limited risk, if you suffer only a 5% loss on your position, you only need a 5.3% gain to get back to break even. And how often are you going to have 100% gains on new positions compared to having a 5.3% gain as well? So why is insurance important? Because you're likely to see 5 to 6% gains. If you just took a loss of 5% to be back at break even or better, then naturally you're going to see 100% gains on new positions. If we control the risk from the start to single digits, which is guaranteed, not with a fickle stop order, you can actually be wrong more often than right and still make money. Now that's not the goal. I don't want to be wrong more often than right, but I don't control the market. All I can control is the structure of the trade and what I'm willing to risk. And so what is possible? I'm sorry, there was supposed to, I apologize, supposed to be a married put graph here, but we've already seen it. Controlled risk, unlimited upside profit potential. But in the proper structure of a limited risk trade, opening that married put with a single digit risk to the downside at the start and the unlimited upside, you can still actively trade strategies inside that nested protected trade that you're doing right now. I can sell calls against the structure. I can sell spreads inside the structure to generate income, but also put me in a better position moving forward, lowering the risk as I go and generate income and potentially bulletproof the trade. Now let's take an example here. Let's look at a real position again with that December decline. Applied Materials. It's a position that I'm in. And after an earnings pop and the stock moved up to about $60, $61 per share, and it went up to about $59.50 prior to the earnings, it still looked like a strong stock in the sector. But when the NASDAQ got taken down in December, it took down everything with it inside of it. So in a 5-day period, we see here Applied Materials dropped from about $59 to $48.50. So right before the decline, and then at a low point here down below. That's a loss of $10.50 per share, roughly 18% on the position. But as of November 21st, before this decline began, the trade that we have open for our Fusion subscribers had a max loss of only 4.7%. We had owned shares of AMAT at about a cost basis of $57.47, and we own an April 60 put at a cost basis of $5.50. So yes, my total invested is $62.97, but I'm guaranteed to get $60 back. So the most I could lose in the worst case scenario, which this isn't the worst case scenario, that puts out to April. Remember I talked about the proper structure. The married put is not new. You can see at your broker that a married put, protective put position will be described as buying a stock, let's say at 50, and maybe buying a January 45 put 1 month out for 80 cents. Low cost for protection. Well, the problem is the insurance in that scenario doesn't kick in until the stock already drops 10%. At the same time, if the stock stays the same or moves up as you expected, hopefully, that put's going to go to zero very quickly. You've lost 80 cents of time decay in a 20 to 30-day period. And if you want to stay in the position, you have to buy another put and then another. With this structure, I put time on my side, and the risk is controlled to single digits. I have plenty of time to do other adjustments, and I can make other adjustments even right now with AMAT at 52, and I'm holding the 60 put. But even if I took this full loss of 4.7%, which by the way it's not at right now, if I liquidate it now I'd only have a loss of 3% on this position because there's still time left in that April put. But even if I took the full loss of 4.7% right now, I only need a 4.9% gain on my next position to get back to break even. Had this been a covered call, over the last month, 30 days from November 21st, where I was limited to a risk of only 4.7%, I could have hedged the stock loss by about 5 to 6%, selling calls and still having a call open for December 29th expiration. Okay? But that's still an 11 to 12% loss. I still need a 13 to 14% gain to get back to break even. Now, had I been bullish on AMAT at the time and done a leverage trade as a bull put credit spread, this would be at full loss. The 80-75% probability when the stock was up at 59 would have been selling roughly the 56 put and buying the 54. Well, we're at full loss right now, and it happened quickly. It would have been tough to manage that position, and this would have wiped out 7 to 8 previous bull put spreads in my portfolio. Had I done a calendar spread, a diagonal spread, I'd be at a similar leverage loss to the bull put, not 100, but I'd be closer to about a 70 or 80% loss, which would also wipe out 5 to 6 previous trades. Now, these are some of the things that are possible. We will see stocks over time, unexpected events that'll drop 15, 16, 17%. What structure do you want to be in? One where that loss could wipe out 10 or 12 previous gains. One where you're only hedging it by 2 or 3% and the 17% loss goes to 14%, but you've still wiped out 7 previous trades. Or to be in a structure where we have the controlled risk first, because I don't know what's going to happen in 2018. I'm not here to tell you that. I'm not here to pick stocks for you necessarily. What I'm saying is, regardless of what happens in 2018, regardless of what the market does, if there's a January effect, anything along those lines, I want to be in a proper structure. Now, we talked about the fear of insurance. We talked about the hesitation of covered call traders saying, well, I don't want to trade the dynamic of my covered call to buy a put because that costs money. I want to generate more income. And of course, you can't buy a put on a bull put credit spread to protect the downside unless you go really far out of the money, because otherwise you're not in a credit spread anymore. You're in sort of a back ratio put spread. Okay? If I were to open a position today, this would be a potential position I'd open. It came right off of the RPM report, which factors in what we look for the stock technicals and stock fundamentals, the proper structure of the married put to begin with, based on what we found works best over the past 10 to 15 years of the radioactive trading techniques. So right now with PayPal, I'd buy 100 shares of PayPal at $74.19. I'd also buy the July 77.5 put for $7.80. Yes, I'm going more than 5 months out in time. I am paying over 10% of the underlying stock price for the put option, but I'm not buying an out-of-the-money put. I'm not buying a cheap put, obviously, because it's more than 10% of the stock price. I'm buying an in-the-money put. This put is about $3.40 in the money. So of that $7.80 I'm paying, $3.40 is intrinsic value. Okay, $3.20 is intrinsic value. The $4.40 or $4.50 remaining is the time value. That's all I'm risking on this position, is the time value. With this structure, my out-of-pocket cost would be $81.99 or $8,199 for 100 shares. But even if PayPal drops to $40 per share tomorrow, I'm guaranteed that at any time I can close the position and get $77.50 back. So all I'm risking is $4.50, the time value of the put, or 5.5%. So we again see another scenario where underlying index or sector drops 5%, the PayPal's in, I might only be looking at a loss of 3 or 4% on the position because I still have a lot of time. Now, am I down immediately? Am I losing money automatically when I open this position? Absolutely not. I did pay $7.80, more than 10% of the underlying stock price for this insurance. I do have a risk of 5.5%, that is true, but that's the absolute worst case scenario. If I hold the position all the way to July expiration, make no adjustments, and the stock is below $77.50, I'll lose 5.5%. But have I lost that money? The fear of insurance, the fear of protecting your position and paying more money into a position. I paid $7.80 for the put. Am I $7.80 behind the 8 ball? No. I just bought it today. I could turn around and sell it at the end of trading today, assuming PayPal is still around $74.20, $74.25, and I'd get $7.60 or $7.70 for the put. All I'm losing when I open this position is the bid-ask spread of the put option. Now, the max risk is $4.49 or 5.5%. Let's just call it 450. So am I 450 down? No. If the stock moves up 20 cents today, I'll probably lose 10 cents on the put because of the proper structure. My delta is only around 0.5 or 0.6. We'll talk about that in a little more advanced webinar next week. But with the proper structure in place, if the stock moves up $1 tomorrow, I'm still going to make 50 cents on the position. I'm not down 349 or 350 because the stock moved up $1, my put goes to zero. That's why I'm buying an April put. Or July put. Time is on my side. Do I need the stock to be at break even to profit? Again, we saw it at 81.99 was my total cost in. And those of you who trade covered calls, you say, well, I bought a stock at 50. I sold a 1 month out 50 call for $1. My break even is 49. Anywhere below that, you're losing money. So do I need the stock in this setup to be at 81.99? Only at July expiration, 211 days away, assuming I do no adjustments, I take no income, and I accept no dividends if PayPal pays a dividend. Now think about this. If I take the 5.5% loss on the position in the absolute worst case scenario, am I okay? Yes, absolutely. Even if I did a no-no, and we talk about the allocation that you'd look for in the blueprint when discussing this and the structure and setting up a portfolio, if I closed out everything in my portfolio right now and allocated 100% of that available cash into the PayPal position and held it to July and did nothing, and the stock was below 77.50 and I realized the full 5.5% loss, am I okay? Yeah. I still have 94.5% of my capital able to trade and enter new positions. Now, I'd never do that. But again, I'm still okay even in the absolute worst case scenario, even if I practice the worst possible portfolio allocation into one position possible, I'm still okay. So the unique structure that we showed, buying a July put slightly in the money, giving us that single-digit risk we want between roughly 4 and 8%, puts time on our side. Now, if I buy a short-term put, which costs less, but could take potentially a higher risk, I'm not forcing myself into an ideal-sized position. A cheaper put, I could buy the 1 month out, roughly 30 days out. January 2018, 19th of January, 72.5 put for $1.25. Now that's a risk of only 4% on the position. So it is a lower risk. But what happens in January if the stock's still trading at 74? This put loses $1.25 of time premium and expires worthless. I now need to buy another put if I want to stay in the position for February. I pay another $1.25. I'm now in for $2.50. And that could quickly lose that $1.25 because of time decay because it's out of the money. And I say, okay, I need to buy a March put. Now I'm at a cost of $3.75. I'm at the pretty much close to the same risk I have in 3 months, 90 days, as the put that I bought out to July. Now that's not a fair comparison because I'm looking at an out of the money 72.5 compared to an in the money 77.50. The January 77.50 put slightly in the money is at $4 for 30 days. I'm paying $7.80 for 211 days, and that's total. Because of the in the money, the risk is only $4.50. We saw that. But think about this. Buying the cheaper, it's almost 50% cheaper to buy a 1 month out put. But I'm going 8 times the amount of time. 8 times. Almost 7 months. Okay, 7 times the amount of time, and I'm not paying twice as much. Far out put costs more up front, but the annualized cost is less per day. So the max risk of $4.50 over 211 days is a lot lower than the maximum risk of about 80 cents or 90 cents for 30 days. I'm paying less per day. And all of you know this. Those of you that were doing the credit spreads and covered calls, most of the audience was looking at those types of strategies today, and there's nothing wrong with that. But when you sell a covered call, are you selling 8 months or 9 months out in time? Well, maybe if you have to manage it because you're trying to roll for a credit and you suffered one of those 15% losses, but when you open a brand new covered call, you might be looking at a weekly, 2 weeks out, 1 month out. Why? Because it maximizes your annualized return, and it gives the stock less time to move against you. Bull put credit spreads, bear calls even. You're looking 2 weeks out, maybe even 1 week out, maybe a month out, most likely less. Why? Less time for the stock to move against you and a higher annualized return if you sell week by week or month by month. Well, those same rules apply when you're doing the opposite. When you're buying calls or puts speculating on a market movement, or when you're buying calls or buying puts to ensure an existing position, you get a lower annualized cost and more time for the stock to move in your desired direction by buying further out in time. And by the way, going slightly in the money, why not am I not just buying an at-the-money option? Well, that's because of what's called the at-the-money bell curve. Right? When you look at a position, you look at an option chain, the highest time value always exists right at the money, the strike price closest. A good rule for selling, not a great rule for buying. As you go further in the money or out of the money, you have less time value. Okay, but we already saw the risk of going out of the money with insurance. The time decay happens rapidly. You can more quickly lose 100% of what you invested in insurance and be forced to buy it continually to increase your annualized cost. And the stock has to fall 5–10% before the insurance kicks in. Going in the money, I pay more, but a lot of it's intrinsic, and I have a lower time premium. That means less decay over this 211 days. That's the proper structure. Now, in the simplistic terms, what is possible? We saw we get into a position at PayPal at $74 per share, and we bought a put that added our cost basis to $81.99. So if PayPal goes to $100 per share, I wouldn't make the full $26 had I just bought the stock at $74.20 or so, but I'm still going to make $18 on the position, or 22%. The stock goes to zero, again, most I can lose is $4.50 or 5.5%. Now that's not realistic, but when you ask as a broad thing, what is possible with a covered call? Well, the stock moves up, you get assigned, you make 2.5%. The stock falls to $10 per share, you don't lose 100% of what you bought the stock at, but you probably lose 97%. It's not realistic. But as the stock moves up and down, just like you might do with your spread trades, your covered calls, we're going to look to apply 12 different income methods to further reduce the risk, generate income, and potentially bulletproof the trade, where we cancel all of the risk. I had a customer, I remember a few years back, who told me that he has no risk, zero cost basis on a stock. I think it was Domino's Pizza at the time, and it was priced around $25 per share. I said, okay, well, where's your put strike that you bulletproof? He says, no, I bought the stock. I have an $8, I had originally a $12 cost basis. I've sold calls on it for 4 years. The stock's at, I've generated $12 over that 2-year time period, so I have no cost in the position. Okay, that's great. That's a really good position to be in, especially where Domino's Pizza is now. But again, it took 2 years to accomplish that on a $20 stock. You buy Apple right now and trade covered calls, it might take you 8 years, 10 years to generate the cost of the underlying security by selling week to week, even month by month calls on the position. We can see a trade be bulletproof in 40, 50 to 60 days, depending on the movement, and there's multiple ways that we can cancel all the risk with the 12 different income methods. Now, why do we teach 12 different income methods in the blueprint, RadioActiveTrading.com? Well, as I mentioned, the only thing I can control is how much I'm willing to risk on each position. I can't control what the stock's going to do, but I know it's going to do one of maybe, let's call it 3 to 5 things. The stock's going to move up, and yes, it's a bullish structure. I'm looking for stocks that are moving up in price, and the criteria we show on the RPM report at Fusion and, of course, in the Married Put Search at Power Options incorporate what Ernie and I personally use to open these positions. But again, what do I know? I know the stock's going to move up, large amount or small amount. or the stock's going to stagnate and do nothing, or the stock's going to move down, go opposite of my expectations in a large or small movement. So when we talk about the income methods, are 12 income methods necessary? Now I bring this up because some investors say, well, why would you need 12 adjustments? That's too confusing. Why not just do one or two things? All right, well, when you're building a shed, playhouse, or you're building a portfolio long term, do you just want to use a hammer and nails? Are you going to be able to build your portfolio consistently over a 10, 12, 15-year period just doing covered calls and rolling up or down as the stock moves? Are you going to be able to build a structured portfolio that's consistently profitable using just bull puts and bear calls and going back and forth between the two, whether you think the market's bullish or bearish, and maybe just liquidating the spread if X is hit, or rolling down or rolling up the spreads? No, you're going to need more things for different market conditions. We want more adjustments, more ways to say, hey, this is not a good time to roll up the call because of the cost, and the stock really moved up 8%. Well, I could do other things inside this structured trade to make that happen. So if I'm building a shed, I'm going to need a drill, need some screws, better have a level. I'm going to want a saw. Yes, I'm going to want a hammer and some nails. I'm going to need different tools. Because of the 12 different income methods we teach in this properly limited risk structure, some are best used if the stock moves up. I wait. I'm patient because I know I have time on my side. I've got that put in place. If the stock moves up, sure, I can sell a call. But there's actually better things I can do going forward. And remember what I showed you. In the first 30 days, if my stock moves up, my put's not going to go to zero. It still has value. Although the put is an insurance policy, it is a second asset that I can manipulate up or down, in or out in time to lower the risk on my position and potentially bulletproof it. If my stock stagnates, I open the stock at 50, I buy it today at 74.91, I buy a 77.50 put for July, and by January 20th, 30 days from now, the stock's trading at 74.18 or 74.19 and hasn't moved. There's 4 things I can do in that situation to generate income and lower the risk on the position while still keeping the insurance in place, or I can even restructure the trade and still have limited risk, but with the potential to lower the cost basis. And just like you would do if you thought a position had moved to neutral, I can do condors and butterflies inside this nested strategy to take in income and lower that original 5.5% risk. And if the stock falls in price, there's adjustments I can use as well. Okay. A comment just came in. It's from Ronald. One of our strategies, the most obvious income method, is income method number 1. It's selling a call against the position. If I open PayPal right now, the last thing I would do is sell a call against it. I'm going to wait for the stock to move up and hit a point where I think it might be a good idea to apply one of the 5 or 6 bullish income methods. But it might not be the call. It might not be income method number 1. Ronald says, I'm constantly managing income method number 1 in this market. I'll get to that in just a moment. Selling the call. When would be the best time to buy back and sell a new call? Should I wait till expiration? Okay, well, this is a little bit deeper than what we're showing today. But Ronald, following the rules in the blueprint, you know that income method number 2 discusses when you should look to roll that call if it doesn't do what you expected when you opened income method number 1. Of course, the full chapter on income method number 1 discusses when you should sell that call, when you should not sell the call based on your expectations and your goals for the position. And there's 4 other income methods that might have worked better for you. And I would never sell a call right away. Remember, my expectation was the stock moved up. We'll talk about that next week, possibly a Wednesday afternoon. So if you haven't rolled the call yet, it's likely because, just as you would, our investors who trade covered calls would say, well, the stock moved up, I want more profit. But you know what? Buying back the call right now is too expensive because the market maker is still asking for time value, and I've got a lot of intrinsic value here as well. And I'm not getting enough premium that I want for the next strike up or the next month and strike out. So if that's your answer, if you haven't rolled it yet because you think you're paying a too much time premium, the answer is likely yes. You should wait until expiration when more time value comes out. But the stock continues to move up, which is actually a negative with selling the call and income method number one. Our covered call traders know that. Then it might be better to manage it now instead of trying to wait to expiration. Ronald, I suffer this view a lot. Well, not suffer it, but I come across this a lot. If I have a married put open and an income method number one, and I'm 5 days to expiration, and I'm $1 in the money, and I see that the market maker wants $2.15 to buy to close that call, I am not giving up $1.15 for 5 days of trading. Even if the stock moves up another dollar, I'm still okay because I'm going to get that $1.15 time premium. But if I see the stock move up 2 points or 3 points, I'm probably considering rolling at that time because the time value is going to be less because it's deeper in the money. Okay, so reevaluate that chapter in income method number two on adjusting the call and other ideas that you can do for the position. And of course, you can also consider income method number 7 going forward on that trade if you haven't rolled the call yet or bought it back. And as you mentioned, of course, the market the way it has been, income method number 1 might not have been the best choice. Just selling the call against the structure, the easiest thing to see, creating that dynamic or calendar collar with the market conditions the way they were. Don't worry, I'm not saying you made a bad choice. You generated income and you're probably still in a good profitable position. Using income method number 1 honestly got me in trouble this year too on AEIS. I was in a married put. In the time frame I was in the married put, the stock moved up 23%. But at a time I thought that it had reached a peak, I went and sold a call. And within 4 days after selling the call, AEIS had moved up from about $65 to $72 per share, about 3 days each day. And my call was still 20 days out in time. So I was waiting for a pullback, and it never pulled back. So I ended up having to roll that for a high cost. I could still get more profit going forward, but that was not what was happening. It wasn't a good idea. Hindsight 2020, still a profitable position, so I'm not worried about that. And the most I could have lost was 5% on that particular position. But in any case, that's what we're looking at. So application of the 12 different income methods. Let me say something else. There's so many income methods out there, you might be overwhelmed and say, well, if I pick up the blueprint and I start applying this technique, how do I know which income method to use? Well, that's discussed in the blueprint when blueprint owners actually have access to an income method cheat sheet to help you as well. But the other thing is that you don't have to sit there and say, okay, the stock did X, should I do 1, 2, 3, 4, 5, 6? No, it's not like that. It's pretty obvious which one you would do in which given situation or which one or two you would do. For Ronald's situation, hindsight 2020, I could go back and say, well, income method number 6 would have been a better idea than income method number 1. But I might have looked at the chart at the same time as Ronald and said, no, income method number 1 looks good. And it's not bad. Generated premium, lowered risk, the stock moved up further than he thought. Same problems we have with covered calls and the stocks that outperform our expectations. Okay? But what is possible? I already showed you what's possible even in a position that's losing. AMAT's losing money right now. I could liquidate it for a 3% loss. I already mentioned that. But the stock's been down 17%, 18% from its peak, and is still now down about 14%. But I could liquidate for only a 3% loss on the position. I call that a win because I didn't wipe out 7 to 8 previous trades. I've only maybe, if I liquidated right now, and the put's still out to April, so if I liquidated right now, I'd only have canceled the gains on 1 or half of a previous successful trade in my RadioActive portfolio. But with the adjustments in place, what is possible? Well, what's possible is I can have controlled risk. I can have the ability to do different income methods in any market condition after I open the trade. And eventually, I can have no risk or a bulletproof position. We showed this the other day on Tuesday. The Planet Fitness RadioActive trade, which was open 90 days ago, 3 months ago, is actually now a bulletproof position. Originally, we bought the stock at $24.60, and I bought a 25 put for $2, so I had a $1.60 risk, or about 6%. And as the stock moved up in price, we adjusted the put I was able to sell to close the 25 put with the stock at 27, still get value back because it was a far out expiration, and buy a 30 strike put. So now my total cost, stock and put plus all adjustments into this position, is only $27.75. I'm guaranteed to get $30 back in the worst case scenario. And for that to happen in the next 3 months, that means Planet Fitness falls to zero or $2 per share. I'm still going to make 8% profit guaranteed, unlike a stop order. If I set a stop order at 30 and Planet Fitness, for whatever reason, gaps down to $24 from bad news overnight, your stop's triggered, but not at 30. You get filled at whatever the market is offering at 24, so now you're taking a $375 risk or close to 15% on your investment. That could happen to me, and I could not even choose to exit. I could stay in the position and perhaps apply adjustments here to maybe lower the risk further or restructure the trade to get a lower cost basis while still having a guaranteed profit on the position. That's what's possible. Yes, it is possible to have a no-risk trade. It's possible to have a no-risk trade without having to spend 2 to 3 to 12 years selling covered calls on a stock that you bought that just keeps moving up. As we talked about with the Domino's Pizza example, or if I bought Apple today, how much time would it take me to cover that cost basis with generating 80 cents or $1 in premium month by month? This was possible in 2.5 months of the trade. Not every trade is going to be bulletproof, but at least probably a third to a quarter of my positions in a given year, sometimes even half of my positions, get to a bulletproof point where I can cross earnings. I can go through any black swan event. The market can do what it wants. Outside geopolitical factors can do whatever they want. I'm still guaranteed to make 8% on this position. And by the way, that's the worst case scenario. If I do nothing more on the Planet Fitness radioactive trade and hold this position the next 3 months to expiration and the stock falls below 30, the absolute worst I'll do is 8.1%. The stock is continuing to move up in price. My liquidation value right now is about 27% if I close the position after, okay, it's about 98, 99 days, I believe, in the position, so a little bit over 3 months. Sure, I didn't get the full move of the stock being up about 38% or so, or maybe it's 37% or so, but I'm outpacing my expectations for this position to even where if I'm wrong in the next 20 days, and I'm in the trade for 4 months, I've still met my goals of 2% per month, and that's guaranteed. That's the worst case scenario, is meeting my goals. Why am I still holding it? Because what do I have to lose? I could adjust it again and have a guaranteed profit of 25% on this position, still with a liquidation value of about 27%. Or I could do other adjustments on the position that actually generate income but leave the upside open, unlike just selling a call. That's why there's 12 different income methods, is based on what I want to do, my goals for the positions, and my expectation of the stock. I can get to a point where I can almost do no wrong. It's almost impossible for me to trade against myself right now on Planet Fitness, because anything I do is either going to increase the guaranteed profit, give me higher upside profit, or both. And that's why there's 12 income methods. I can even combine them, and that's what the blueprint does. It walks you through when and how to use each one, and how you can even combine some of the income methods to sort of double dip on lowering the risk and generating income at the same time, whether you're bulletproof or not. Now, I had mentioned that I never do an income method right away. It's not something I do, because that would put me in a position where I trade against myself. But a lot of times if vets say, oh, well, can you use weekly options with the structure? Of course, but you don't want to force an adjustment. You don't want to force selling premium week by week by week if it puts you in a wrong situation. Let's think about PayPal again. I buy it at $74.20, buy the put at $77.50. Now, I'm not going to sell a $77.50 strike right now because there's no premium. 2 weeks out, 3 weeks out, 1 month out, it's not there. It's not worth it. Do I sell a 75 call? No, not at all. Because remember, when I open this position, it's because I am bullish. I would have researched and analyzed the position with the tools on the Fusion subscription or on Power Options, chose this position because I think it has the potential to move up 3 to 5% or closer to $77 in the next 30 days. If I sell a call at 75 or 76 right now, I am trading against myself for a small amount of premium. I have the time to be patient. I'm not losing anything but the bid-ask spread on the put. So if the stock does move up as I expect, I can now get double or triple the premium I could get today at a higher strike of 77, 77.50. Okay, so you can actually trade against yourself by forcing an adjustment. Is it always better to sell premium? I think we've already covered that. We showed examples of what we could expect in covered calls and why those of you, some of you, trading the covered call strategy have not met the expectations you wanted. Might not always be the best idea to sell premium, because whenever I sell a call or a put, even in a combination of a spread, I'm entering an obligation to do something. And if the position goes against me, I don't control that contract. The other side, the buyer or the market maker between us, controls what happens to that right and that obligation, not me. Okay, so you can get caught, and we've all seen that very quickly, with the obligations of selling premium. And we saw with the trade simulator tool, over time, in any strategy, including this one, you're going to have strings of winners and losers. You're going to have losers that you can't catch because of an unexpected event violates a stop order or breaks through your mental stop, and now you're looking at a situation you didn't want to be in because of some outside force. What can I control? I can control the risk on my position. I can control it to single digits where even if I take the maximum loss on one of my radioactive trades, I only need a small gain to get back to break even on the next one. That's the only thing I can control in the market. All right. Now, one more thing here. I'll just show this. Bragging about the losers. A couple of years ago, February to August 2015, I was in a stock icon as a married put position. During that 6-month period, 5.5-month period it came out to be, the stock fell from $36 to $12.25. It's a loss of about 66%. Because I was in a married put structure, radioactive trade, I was long stock that entire time. The worst thing that could have happened to me is that I could have lost 5.8%. But with 12 different income methods, some that work when the stock falls or you're anticipating the stock falling in price, we actually closed the icon for a gain of 4.1%. That's nothing to brag about. 5.5-month position, I only made 4%. You probably did better over that time frame with a different strategy. But again, if I had done it as a covered call, over that 5-month period, 5.5-month period, I would have only reduced the risk by 18% by premium. I'm still taking a 47.9% loss on the icon trade. And what did we see earlier? What happens when you take a 50% loss or close to it on one position? You need 100% gain to get back to break even. Even if I had taken the maximum loss on icon of about 5.8%, I only would have needed a 6.1% gain to get back to break even on what I lost on that trade. Did anyone have 100% gain on a covered call strategy in the last year, trading week by week or month by month, that would have countered a 48% loss on one position from 2015? If you can, send me that in the post. I don't know if you did. Now, I already mentioned this. Is every position going to be bulletproof? No. A fourth to a third or a half of the positions in a given trading year that I open are probably going to be bulletproof. And not every position is going to be profitable, but again, the worst I'm going to suffer on a losing trade is a loss of 5, 6, 7% with this structure, which means I only need a smaller gain to get back to break even. I'm not going to have an unexpected loss of 15, 20, or 25% where it might take me 8 months, 10 months, 15 months to get back to break even. I can get back to break even on the money I lost with the next trade in a 20 or 30-day time period if things work out the way I want. Okay? Now, think about what we just showed you. Even the spread traders who are doing leverage positions, the structure that I'd open today similar structure we saw in PayPal only had a risk of 5.5%. And think about that for a moment. What I want you to think about, those of you doing cover calls, even those of you buying calls and puts, maybe magnify it 10 or 15 times. But think about this. What if you had kept your losses over the last 12 months to only 4 to 6% on your investments? Okay, would that have made it a better year for you profitable-wise? If you're trading, long calls where you took 100% loss, what if you only took a 50% loss? Or if you focused on the risk first rather than trying to hit the home run? And for bull put spreads, if you took 100% loss in your position, or even a 50% loss, what if you cut that down by half or a factor of 10? Okay, how would that have affected your portfolio long term? So hold on one second, folks. I do apologize here. Let me try to get this again. There we go. I'm sorry. So, of course, if you kept your loss limited, even on leverage trades, to 5% or less, would that have not affected your positions because you're already practicing some portfolio allocation? Would you have lost money last year but lost much less and have more money going forward in 2018? If you had a losing year last year, with just what I showed you today about controlling risk and what is possible, would that have turned a losing year into a winning year? And who would have saved more than $5,000 in their portfolio by just this one simple tweak to limit the risk on your positions to 5 to 6% while leaving the upside open and not even including the 12 different adjustments we could use on the position? All right, so let me go ahead and close that, folks, and I'll share the results with everyone. 17% of you said that keeping your losses to 5% or less would not have affected you. Well, we saw that Ronald's already practicing the radioactive positions there, so he might be one of the 17 that answered that. But others of you doing the spreads are probably, hopefully, practicing proper allocation. But we showed with the trade simulator view earlier that even if you had $10,000 or $100,000 account, but if you had a $10,000 account or $10,000 that you allocated to spread trading in a larger portfolio, of course, even if you allocated 25% of that $10,000 to 4 separate trades per week or per month, we saw how you need to be right more than 80% of the time in order to profit long term. So you really have to apply that allocation to make sure a spread isn't risking more than 3, 4, 5% of your total portfolio value in the worst case scenario. Well, 17% of you said you still might have lost, but you would have lost much less. And 50% of you said it would have turned a losing year into a winning year. That's, to me, the most important. Well, 17% of you would have saved $5,000 or more. That's really the most important. But the 50% of you that would have turned a losing year into a winning year in the last 12 months, had you applied this, I don't want to ask you this question again on December 21st, 2018. Okay? I don't want to ask you if you had limited your risk to 5 to 6% in 2018, would have you had a better year? Okay, so I want to see you act on that now so that you don't have the same issue. And don't get me wrong, okay? And then I didn't say this, so don't get me wrong, it's the wrong statement. One thing I'm not telling you to do, now I do it with a large bulk, but what I'm not telling you to do is to stop everything you're doing right now with options and pick up the blueprint, and starting on January 1st, you allocate 100% of your capital into the radioactive trades. I don't want to see you necessarily do that. But I do think that this approach should be in your portfolio. And if you're close to retirement, I think 50 to 60 to 70% of the funds you're trading with as you get near retirement or in retirement should be allocated to this type of limited risk strategy. You don't really have the time to see 20%, 30% losses, or 80% or 50% losses on spread trades. You can still take 15%, 20% of your portfolio and allocate it to more active trading and more spread techniques, more leverage tradings for fun, buying calls, straddles on earnings, calendar spreads, or other techniques you might be trading. But I do want to see, especially for those of you that this would have made a change and turned a losing year into a winning year in 2017, I want to see you start applying this technique into your portfolio with a good portion of your trading account. Control the risk, okay? What is in the blueprint itself? We've talked about the technique, we've talked about the 12 different income methods, but really what's in the blueprint? It details how to properly set up the protected position. I showed you an example with PayPal of what I would open today if I was opening a Mary put on PayPal. There's a way to set it up incorrectly. There's such a thing as taking on too little risk, and we'll talk about more of those details next week. But at the same time, the blueprint gives you the proper definitions and guidelines to setting up the limited risk trade correctly. It details how and how not to use each of the 12 income methods. There's actually a 13th income method, and I'm applying it with Planet Fitness right now, and that's do nothing. Guaranteed a profit. I could do 4 different income methods, a combination of 3 of those 4 income methods in different ways to generate income and lower the risk further, and both increase my bulletproof status and generate income. But 13 is do nothing, because if the stock continues to go up to 34.50, 34.60, 35, 35.10 or higher, I'm just getting better return, and I'll have more opportunities to increase all of that better. And if it falls, then I can make an adjustment too. Okay? But there's how and how not to use each of these 12 income methods. As I mentioned, there's additional chapters on when to exit, when to just say, you know what, it's time to get out, one way or the other, met my goals, didn't meet my goals, and the full chapter on combining income methods plus case studies and more. It is the full manual on properly applying this proper strategy and this proper technique into your portfolio to control risk properly, still take advantage of further upside, and still have a wide range of tools in your toolbox to get better income, to generate income without fear of loss, to generate income without fear of one bad trade going against you and wiping out 10 others. All of that is nullified. I teach a lot in these webinars, and many of you are probably tired of hearing my voice after about an hour and 20 minutes so far. And we do teach a lot, but you're not going to learn the ins and outs of this full strategy and this full technique and the 12 different income methods through the webinars alone. That's only described in the blueprint. And of course, at the end of each year, we want to make it easier for you and make you feel more comfortable with taking this step to start protecting positions in your portfolio with the end of the year promotion. Go to radioactivetrading.com/EOY and you can see the full benefits of the special end of year offer beyond the benefit alone of controlling risk properly and having the proper structure. Remember, 17% of you said that keeping your losses to only 5% wouldn't affect your position. And 17% said you would have lost but lost much less. 50%. This would have turned a losing year into a winning year, and 17% would have saved. Well, let's look at that numbers. That's 83, 84% of you would benefit from picking up the blueprint and start applying this in your account into 2018 without the bonuses that we're offering. Just the structure alone is going to help you turn that around. Just the information in the blueprint. But you know what? Here's what we're going to offer you. You go to that link, radioactivetrading.com/EOY. I'll send it to everyone here. And we're going to give you a series of bonuses to help you get started, to help speed up your education, and to help speed up applying this in your account. You heard me talk about the Fusion subscription at Radioactive Trading. There's a basic RPM report there which shows the exact positions that Ernie and I would choose from and Greg would choose from if we were opening a new radioactive position today. Speaking of which, the Fusion subscribers get to watch the radioactive trades that Ernie uses, that I use, and that Greg uses. We post when we open a new radioactive trade. We post when the income methods are applied, when the adjustments are made, and more. There's also members-only webinars and videos for Blueprint owners and for Fusion subscribers as well. But the first bonus, Fusion subscription is usually $69 per month. But as a Blueprint owner, if you pick it up before December 31st, you'll get access to your first 2 months of Fusion for only $10 per month. So that's a value of $118. There's 6 Mastery Series CDs that we put together over time to show some of the income methods, adjustments of the income methods, the hows and the whys in more of a video format if you prefer to learn by video. That's the home study kit. The home study kit includes the blueprint and all 6 Mastery Series CDs, or videos I should say, not CDs, but the Mastery Series videos. If you pick up the blueprint, you'll get the 2 months of Fusion for only $10 per month. You'll get the first Mastery Series video, The Foundations of Radioactive Trading, for free. Now you're also going to get 1 month of Power Options for free, $60 value. But we'd hold off on that. If you pick up the blueprint for the end of the year special, going forward into 2018, realizing how this would have turned last year from a losing year to a winning year by just applying what we taught today, just the first step, not even beyond the income methods. If you pick up the blueprint, go through it once you receive it, start looking at Fusion, and then eventually you can graduate over to Power Options. These 2 bonuses here, first month of Fusion, or first 2 months of Fusion, the first month of Power Options, that's ready for you whenever you're ready. You don't have to start it right away. You can wait 4, 5, or 6 months if you want, and then still take advantage of that first month of Power Options or the discounted 2 months of Fusion. We're going to send you a quick start guide to help you get started more quickly when you receive your blueprint, so you can start acting on that almost immediately. Anyone who picks up the blueprint between now and December 31st, the end of your promotion, you're also going to get access to the newest Mastery Series CD, Income Method number 12, that's going to come out in January. So I'm giving you 2 of the Mastery Series videos for free, both at an $89 value if you pick up the blueprint at the end of webinar, end of your special. We'll also send you another video with our top 4 most popular webinars that we teach. And of course, everyone gets email support free. Fusion subscribers, blueprint owners, you can send us an email at any time, call the office during market hours with any questions that you have. And of course, this year, we're also going to include free shipping. The blueprint is, as you saw here, it's a physical product, a 3-ring binder, about 250 pages, walks you through chapter by chapter. The chapters are split out so it's easier for you to navigate through. It is a physical copy that we ship to you. Usually it's $11 shipping inside the U.S. or up to $60 outside the U.S. We're going to waive shipping, so no shipping charge at all. $339 for the blueprint with all the bonuses that are available, which add up to way more than the cost of the blueprint as well. Okay? In addition to that, the blueprint also comes with a money-back guarantee. If you take advantage of this end-of-year offer before December 31st at midnight, and you start going through the content, and a little bit into January, so a couple weeks into January, you decide it's just not for you, or you want to wait for a while. Maybe you want to come back and visit it later. If you're not satisfied with this approach for your portfolio, send it back to us. We'll give you your money back, no questions asked. Okay? And again, as I mentioned, going through the year as a blueprint owner, even if you go through the blueprint, you think it's a good product, but you're not going to start applying it right away, over the course of the year, you'll also get access to special members-only webinars for blueprint owners and for Fusion subscribers as well. Okay? So those are 2 other bonuses that are available. What did we talk about today? We talked about what's possible with radioactive trading, fighting the fear against opening some strategies such as a covered call and suddenly without warning having a 15, 20, or 25% loss that just wiped out 12 or 15 previous trades. Or with the credit spreads, suddenly taking an unexpected event, a black swan event across the markets, or just something in your sector, and seeing a full loss on the bull put that still has 5 to 10 days to go, which was near profit or would have been profitable had nothing changed, and having that wipe out 10 previous trades. And we also showed you what's possible, that yes, at times, a third, a fourth, or 50% of the time as well, you can be bulletproof on your positions, have no risk going through earnings, have no risk of fear for any black swan event, with still realizing unlimited upside. The money back guarantee, we want to start off a relationship on a bulletproof idea. Okay, what is the bulletproof idea? The bulletproof idea is the fact that You can purchase the blueprint today for $339. Get all of those bonuses that we showed on the bonus page, but with the money back guarantee. No risk to you. This is a bulletproof offer. This is a bulletproof investment to improve your portfolio going into 2018. Okay? All right. So, I'm sorry, I apologize here. Different Roland. Roland A. Roland B was the question earlier on Income Method number 1. Roland A just coming in and said, Michael, I just ordered the blueprint. Do I get these year-end bonuses listed above? Yes. I'm going to make sure that you get those. You'll start to receive some of those. Links to the Foundations of Radioactive Trading CD and the Foundations of Radioactive Trading video, a link to the video and a link to the FIST video as well. You'll receive those via email. So you can look at those actually while you're waiting for your blueprint. And again, the 1 month of power options and the Fusion subscription discount, you have those right away too. If you log on to power options, if you want to start now, but you don't, you can wait. But when you're ready, you log on, it'll start 30 days from when you first log on, and you can activate those at any time. The other one's the quick start guide and the, I apologize, just lost it in the list here, but the quick start guide, yeah, that's the only one. You'll receive that with your blueprint package when it's shipped to you, and you'll receive it in 2 to 3 days. All right. Okay, so we're going to make sure that you have all of that too. So questions, and what next? Well, we did record today's presentation. I'll get it posted soon. I'll let you know when it's archived. Feel free to review the archive of what's possible with radioactive trading. Pick up the blueprint or the home study kit before December 31st at midnight. Take advantage of these bonus offers we're giving to you. Now is the best time to get in the blueprint. If you've been on the fence, if you've been considering it, there's no better time to get these because they end December 31st. But aside from that, without the bonuses, the 50% of you who told me that just the structure, without discussion of the income methods, but just the structure of limiting your risk to 5 to 6% would have turned a losing year in 2017 into a winning year. You want to act now. You want to take advantage of this. Pick up the blueprint. We'll send you the bonuses. You can wait on the Fusion subscription. You can wait on the Power Options free month as well. Start going through the materials. So come in the next couple of weeks, we'll be ready to start opening that structure. We'll be ready to start limiting the risk so I don't have to ask you again in 2018, hey, Option Smart Service Extraordinaire over here sent you an email on January 15th promoting this new can't lose income strategy of a double-blind calendar diagonal condor with a backspread twist where you can only lose 2 or 3%, but likely 90% of the time you're only going to make 1 or 2%, but it's guaranteed, and you're opening 6 to 7 leg positions every 8 to 10 days. Okay, don't fall for that. Research it, analyze it, but I don't want to see you go that route. I don't want to see you fall into a promise where someone I know is offering another promotion and is offering you a strategy where they made 300% in 2 weeks and 600% in 4 weeks and 300% in 3 weeks on these positions. Get in now before January so you can take advantage of this as well. What the market has offered in the last 6 months to 12 months is not going to be the market conditions in the next 6 to 12 months going forward. What worked last year might work better next year depending on what the market does, or it could be disastrous depending on if the market conditions switch. Can you control what the market's going to do in 2018? No. What you can control is your structure. What you can control is the risk you're willing to take going forward. And if the market continues this trend, even with limiting risk, you'll still be profitable, nicely profitable in 2018. If the market reverses, you're capturing more of the gains or even restricting losses, and you have 12 different income methods you can do to further control the risk and move forward. Lower the risk even if the market's falling. And there's ways that we can play this in a bearish market. You'll see that as a blueprint owner also. So if you have questions later on, remember, Send me an email at any time to support@radioactivetrading.com. You can also call us during market hours at 302-992-7971 with any questions, and I will let you know when this webinar has been archived later this afternoon so you can access it at any time, review the information, and then we can go from there with your questions and beyond. All right? So if you're on the fence, you want to stop losing money, you want to try to make money by controlling the one thing you can control in the market, go to radioactivetrading.com/EOY. Take a look at the bonus offers, pick up the blueprint, and then we'll go from there too, because you'll have access to me, to Ernie, to all of us going forward, and we'll start 2018 off on the right foot with controlled risk, unlimited upside, and a bag of 12 different tools that we can use to further improve our situation and our positions. Thank you very much for joining me today, ladies and gentlemen. I hope you have a fantastic trading week and a very Merry Christmas and Happy Holidays if I don't see you in the next 5 to 10 to 15 days before the new year. But hopefully I do, and hopefully you'll become a blueprint owner and join us here at Radioactive Trading. Take care, everyone. Good night.